Welcome to Get Real with Jack and Cindy, where the stories are polished and the advice isn't trendy. We talk houses, markets, and the life that happens in between. The wins, the screw-ups, and everything unseen.
Wait, I have a fixed mortgage and my house payment just went up? How can that happen? We're hearing that a lot these days. Hi, I'm Cindy Morrison, and this is Get Real with Jack and Cindy.
And I'm Jack Wallace. You know, it is kind of one of my pet peeves when people say, oh, but you should buy a house because then your payment is fixed. Your payment is not fixed. Your principal and interest are a fixed amount, and they don't change. But trust me, the rest of it does fluctuate. It absolutely does. I think whenever I got my house, the payment was like $12.95 or something, and then it's gone up all the way almost to 16 before. Mm-hmm. It's gone down to 15. It's gone, I mean, like it kind of goes back and forth based on the insurance and the taxes kind of, you know, that's a 3% valuation, blah, 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 like they go up. But that first taxation can be a big jump, and let's explain why.
Okay, so when you're making your payment, you've got your mortgage payment.
Right.
You've got the interest. You've got...
So many interests.
You've got... True, when you own a home. You have
So that's like if you're 6% interest. So like if you're 6% interest, that's going to stay the same. That's
right.
Fixed.
And then you have your taxes and insurance. That's what's changing.
Right. Now, the one thing about your interest and principal, so as you go down in years, the 6% interest, let's just use that, is on the total amount of the loan. Mm-hmm. And as you chip away at that slowly at the beginning, mm-hmm. then it doesn't change your payment in that way because then more principal gets paid. So we've fixed that number, even though the amount of interest and principal switches around. Right. That number is fixed. So let's say that is $1,500, and at the beginning, $750 of it is interest and $750 of it is principal, just for sake of ease. Over time, it may be $800 and $700, and then $700 and $800, but that number is still going to stay the same because you're just taking more principal off and less interest. And so that's how it's amortized over the loan of 30 years. So basically over 30 years or 15, it ends up being exactly the same number if you pay just that, and then it balances out to where the end you're mostly paying principal, less interest.
Correct.
So that's how that component of it works and why it doesn't fluctuate in the total amount, but it fluctuates in how that total amount makes up.
Sure.
Okay? But then when it comes to your taxes. So let's say I buy a house for $200,000 that has not transferred hands in 20 years, which is pretty common. Mm-hmm. So the valuation of that house over time with those taxes, they've allowed a 3% increase, but no real bump ups. We have had a few bump ups because mm-hmm. there's been some, but in general, that value is going to be lower. That tax is going to be lower than it should be because it was what they paid for it, and then 3% interest or 3% increase. Mm-hmm. So when you buy it, it's sort of a reset on the clock. And so once that all gets finalized, then they're going to look at, the new value is what you paid for it. So mm-hmm. let's say now you paid $200, but they paid $50. So now they're gonna jump your value up, and they're gonna tax you on the $200.
Or even if it had been a house that they bought pre-COVID and you have now bought
100%.
it post-COVID, those taxes are going to be very different.
Absolutely. So then suddenly you've been going on a tax rate that was the existing tax rate, and now you've got this house, and it's going to jump up. So especially like in new construction, that can really bite mm-hmm. you because if they don't do it correctly, then suddenly the next year you don't have tax on that first year, and then suddenly you have a lot of tax because they're taxing you for the full amount that you purchased as the value.
Right, instead of the lot purchase.
Yeah, and there's even lawsuits with some companies because they weren't they were getting people into the house by not doing that, and then they weren't disclosing to them that there was going to be that added to it. I mean, and that's almost like another payment for some of those newer homes. And so that made a huge difference, and a lot of people couldn't afford it, and then they were stuck. So that number is one to really look at. And you should be able to look at your the rate of like living in the city of Tulsa Jinx schools. There's a certain percentage number that's going to be the taxation of the value. So they should be able to figure that for you pretty easily and tell you kind of what it's going to be, at least a really good ballpark. So that part is it. And then that can be increased up to 3% every year. They can increase 3% of the value each year. So it's a pretty minimal jump, but it does jump. And then
I've seen a lot of people who did buy pre-COVID, but property values increased so much that all of a sudden they were paying so much more taxes than they thought because maybe the houses in their neighborhood had doubled.
Yeah.
And guess what?
And then sometimes the city and county can ask for, like, if there's been a big increase in general, they can ask for a jump up where instead of like what that, the normal one is. So you sometimes will get those kind of, all of a sudden it'll go up quite a bit because they're bringing it up. So it just depends. And also for people that are over 65 on a fixed income, you can get your property tax to be frozen. So you still pay it, but you don't keep increasing.
I love that.
Yeah, and people don't know about that. And you have to have you have to be on a pretty fixed income not making much money. So if you're somebody who's making a whole lot of money in retirement on your investments, that may not be where you're qualified, but check on that because that can really help.
Real estate is feast or famine, so where do we fit on that?
Yeah, right. Yeah. Well, I mean, what have you made the last 2 years? I guess. But so that's really important that you know those things because the tax part of it is some of that increases. But what's really unpredictable is your insurance. Mm-hmm. And that's really something that can, you also people tend to not shop it every year because they just kind of in mine, I have to be honest, I've let mine go too high and it's time for me to shop it because all of a sudden, I was paying $1,200, now I'm paying $3,800 or something crazy. And it's like, it doesn't make a lot of sense. I do know that it has all gone up, but with my mom, we just did it where she shopped and it ended up being a company that we always thought was the highest company and they were like 60% of the cost and better insurance. So you really do need to constantly, every year you should look at that because it just goes to your mortgage. So you just go, oh, well, it is what it is. And then they have to take out a different amount each month to escrow for that amount to make sure that it's paid, and they're anticipating it being the same or more the next year. Right. So that does add on. So, I mean, $200 or $300 fluctuation a year is not uncommon with those two factors.
And last I checked,
and very rarely does it go down.
I honestly didn't check right before we started this podcast. But I know at one point we were one of the top 3 disaster states. Yeah. It was Florida, Texas, and Oklahoma. So at least we're, I'm sure, still in the top 5. So that does mean your insurance is going to be a little higher. And heaven forbid we have tornadoes come through. So...
Or remember it used to be, well, at least we don't have earthquakes.
Yeah.
Yeah, we do.
Although we don't have as many as we used to.
Yeah.
We're not even going to go there. We're not going to get into that controversy right now. We're in oil country.
It's funny when they stopped doing what they were doing that supposedly wasn't causing them, then we don't have them. So yeah, it is interesting right now. But but it is like we were having more earthquakes than any other state. I mean, like we went from being like we were tornadoes, then we were earthquakes and tornadoes. I mean, so yeah, it is interesting. And then flooding this year has been crazy.
It's last spring.
And your insurance does not cover flood if you do not have flood insurance.
If you live in a flood-prone area, you have to get flood insurance. But if you live in an area that could flood, maybe not flood, I think about, right before COVID, 2019, we had that big flood, and places that normally didn't flood and flooded. And
our city has done a tremendous job with flood mitigation and prevention, but it's still, I mean, like that river is full of water right now, which never it's never full of water.
I think it was 1984, 1985 when they had the deadly floods. Tulsa
It was
really.
1984 because it was my senior
Okay.
year. I was in Mexico on my senior trip.
Oh, when all that happened.
Yeah.
Yeah, deadly floods.
Crazy.
And
51st and Harvard was like underwater.
yeah. So luckily Tulsa came in and really started doing all the retention ponds, and they've actually won national awards
Yeah.
for what they've done to
Other cities come
make
and
the
study.
water go elsewhere.
Yeah, other cities come and study how we did it, and that's why you have all these beautiful ponds with fountains, and it's really the retention. But my gosh, we were driving down. I was out showing houses, and we were driving back from Jinx over by Yorktown, like last week when that one just heavy downpour came, and like all those soccer fields that are made for flood were full of water, and it was just. I mean, when Tulsa goes, when that rain comes, it is something.
Okay.
It is kind of amazing.
When the wind comes sweeping down the plain, it should be when the rain comes sweeping down the plain, both of them.
Yeah. And then it'll be the Sahara. I mean,
Yeah.
we were the desert forever, so, and we're kind of going back to being the desert. It's sort of an interesting. We put in during the Dust Bowl, we put in all the lakes, and then put in grass. So we created it to not be. But the reason we had Dust Bowl is we were a desert.
Right.
So we've created the most humidity and all. I mean, it is funny, man.
We have more man-made lake shores than any other state.
That's why all of us have inner ear infections constantly.
True that. That's why we're green country now.
But those are so those are the things that you have to really think about. So whenever they tell you, oh, if you buy a house, then you guarantee your price, monthly is going to be the same from now on. No, it is not. It is going to keep it down. I mean, I think that you're probably going to be
Two
better
of the
off.
four.
Yeah.
Two of the four are going
gonna
to
be
stay the
fixed.
same.
But that does not mean, I mean, so if insurance goes really high and your taxes are going to go up a little bit, you're going to be paying a little bit more. I mean, I think that's just part of it. But shopping your insurance can really help. And then also, I'm really studying this. There are some companies now that are doing that insurance for covering your deductible or covering whether it's actual cash or replacement cost.
So kind of like the Aflac.
Yeah,
of
like gap
homes.
insurance
Yeah,
for those things.
okay.
So I'm studying that, and I'm hoping to have some people on here that are going to talk about that because I think that's so great that we could have that. So then it might allow you to get an insurance that isn't as high yearly, but take a higher deductible and then have that offset insurance on that.
I love that.
So we're trying to figure out ways for you to cover yourself and be prepared, but at the same time get that down. But right now, that is, I mean, it has gone way up. So everybody's payment has probably gone up quite a bit because of that, and that's just part of it. So again, whenever people say it's cheaper to rent or to buy than rent, yes and no. And when they say, well, at least then you know every month what your payment's going to be and it's going to be fixed, no. Now, if you're going to be in the house for 20 years, that's the thing. This is important. 20 years, it does give you some inflation protection because a principal interest payment, like what I pay after 20 years, my principal interest payment, trust me, is really low compared to what I would be paying right now. Now, that's also because my interest rate was really low when I got it, but also just, what we paid for the house and all that, so that it does help inflation-wise, but very few people live in a house that long, honestly.
Right. And let's talk about, so for people who may be out there, they think they're, what they're going to pay is fixed. They're figuring out it's not. They're at a higher interest rate than maybe it is right now. When does it make sense to refinance?
Okay. This is important because then every loan has cost. We call them closing costs. We don't talk enough about what that all means, but you're having to get an appraisal. You have to pay that price. You have to do an initiation for the loan to the loan company. They have to make some money on that loan.
Right.
You've got to maybe pay down the interest rate, which that's an amount. You've got the closing company who has to examine the title and do the recording and facilitate the deal. You have title insurance and all those things add up, right? So if I'm borrowing $100,000, I may have say $6,000 in closing costs. So that suddenly is $100,000 that I'm getting from the bank, but I have $6,000 that I've got to pay. So what you do is figure out at what point it's cheaper to that you save enough money on your payment over a certain amount of time to offset that cost.
So don't refinance right before you're going to sell.
Yeah, or if you've got, let's say it's going to save you $100 a month and it's $10,000 in closing cost, it takes a really long time, like $1,200 a year times what, almost like probably 8. So 8 years would be if you're going to stay there for 8 years, you would break even on refinancing.
Right.
So that's where you got to, it sounds weird because people, but like that's where you look at that, at whether or not the break even works. And a lender is really good at doing all the detail work to tell you exactly what that number is and where you would, a good lender. So I think that's really, it's easy to think, oh, if I could just get a little bit off my mortgage every month, but well, that's not really going to be the best if you have to pay for that, for the ability to do that. So looking at that break even and when that break even occurs, and like you said, if you're going to sell it in next month, it's stupid to do that. But I think that's when the people really kind of, even to get the interest rate, like there's a certain point where the interest rate coming down only makes so much difference. And it's the same formula, but that's basically, it's the cost of the loan and what the real cost of the loan is, including all the closing cost and interest cost compared to what you're already paying, and then looking at those side by side.
Right.
And how long that difference takes you to break even and how long you plan to be in the house. If it's your forever house, like truly your forever house, it may be a great thing to go ahead and do it. But otherwise, I think it really, very rarely is it the best thing to do.
Right.
Now, if you have an adjustable rate mortgage, that's a whole other ball game.
Okay, let's go down that rabbit hole.
Okay, so we've been talking about a fixed rate, which your rate is the same. An adjustable rate mortgage, which has been pretty common lately, is if you think the interest rates are high today, but you think that in 5 years they're going to be lower. It's a little bit of a dangerous game to play. But if you think that's going to be the case, so you take a lower amount right now, you buy down and you take a lower amount, but in that 5 years, if you don't pay that loan off, it's going to jump up to the higher rate. It's like gambling or trying to predict the future that's going to be lower. So when you get down to that end, you got to make the decision, like, how am I going to do this? And that time is of the essence to get that to where you're maximizing, because suddenly your payment could jump way up if you don't do anything.
Oh, scary.
But if interest rates have gone up and it's going to be at that rate that you're already at and you have no ability to do anything, then you may have to sell to make it, because you can't afford it at that point. So you have to really think about that. I think
And balloon payments, same
thing. So basically a balloon is that at the end you're going to have to come up with, it's similar.
Yeah.
You're going to have to refinance or pay a big amount. One is that the loan stays intact, but the payment goes up, and the other is you have to come up with an amount of money.
Right.
But either one, it's just a matter of whether you're willing to gamble with that. But for some people, they're only going to stay in a house 2 or 3 years, and they're doing a 5-year ARM. I mean, it can be a pretty good way to go. But you just have to be prepared, because if life changes, kids.
It does.
Changes.
How many people have told us, "Oh, this is my forever home," and then 2 years later, you're selling that one, and they're buying.
Well, how many years have we heard interest rates are going to be lower in a month? Interest rates are going to be lower in 2 years. 6% is a pretty normal. Like, I know people get tired of hearing it from us, but it is true. Historically, 6% is a pretty good normal interest rate. It's just really high compared to what we've had. I have a lower interest rate and I'm not going to, I understand. I'm not saying that means you should just go ahead and do it. I just mean waiting for that to get back to that unnatural number that we've been living under.
That is not
probably
sustainable.
not the way to, because they don't make enough money. That's, it's a business. And so 6% is more of a break even for them. So that's going to be the case.
Awesome. Well, so we searched through Reddit, and we wanted to know what your number one question was. And that was it. Why, if I have a fixed rate, is my payment going up? So I think
again, when you hear people say it may that if you buy a house, you're going to have a predictable monthly and you're going to know exactly what it is from now on. No, it is going to be different. Not going to be wildly different, but $300 different is wildly different for many people.
Oh, absolutely.
It is for me. I mean,
right.
So I just think you have to be prepared for that. Is it going to go up double or probably not?
Awesome. All right. Well, thank you so much for joining us. Oh, before we leave, you have camp going right now.
Not yet. Well, I guess we will when we see this. But yeah. So, and on the 25th of July is the performance. I think it's $10 a ticket, but it is the best kids from all over the world.
I've been,
performing.
And it's amazing.
So if you want something really fun to do, July 25th, the Broken Arrow Performing Arts Center, the Kristen Chenoweth Broadway Boot Camp performance. Come see us.
And where all do you have kids coming from?
We've definitely, Australia's our big market. Australia, some from South America, England. I mean, it's crazy. I think last year we were 8 countries. I think this year we're maybe 6 countries.
Okay.
So, but Australia loves coming here.
So,
like literally halfway around the world.
So, funny side note, one of my favorite shows to binge watch is America's Sweethearts, about the Dallas Cowboy cheerleaders.
Oh yeah.
Oh my God, I love that show. And actually, it would have been last year, but this season. So, well, it would be this series, like this season of the show.
Okay.
It was actually last year when the girls were trying out.
Okay.
And women were trying out, and their whole season. So, but one of them is from Australia.
Oh, interesting.
And I love
them. They're such fun people.
Oh yeah, I immediately thought of you.
Yeah, I mean, I have like this whole family in Australia now of people like, they're all like, come stay with us. I mean, it's crazy, but
we could take this on the road.
Oh, we could, yeah. I would be interested in like, what's the difference in Australia and real estate compared to, I mean, it would be interesting to see.
Then it would be a
like
write-off.
I keep getting videos from different parents and stuff, about this year and how they're excited. And they're like, this is their winter. So they're like in sweaters and scarves and stuff right now. And I'm like, well, you're going to be here for 105, so be ready. Yeah.
Bring your shorts.
But yeah, we're really excited.
And this is how many years of the camp?
I think this is our 12th year, but it's our 11th camp because of COVID.
Oh, that's right. Yeah.
Because last year was the 10th. Yeah.
I just love that y'all do this, and that Kristen is coming back and giving back to where she grew up.
Yeah, and I get my roommate back for 2 weeks.
Yeah, you do.
Yeah.
Your
excited.
bestie.
It's so fun. It really is fun.
It's all right. If I have to be, second chair of a bestie behind Kristen Chenoweth, I will take it.
All right, okay.
All right, well, everybody, thank you for joining us.
Thanks.
Welcome to Get Real with Jack and Cindy, where the stories aren't polished and the advice isn't trendy. We talk houses, markets, and the life that happens in between. The wins, the screw-ups, and everything unseen.